Hello everyone. In this video, we're going to be talking about diversification. Imagine putting all your money into just one stock. If that company does well, your investment may grow. But if that company struggles, your entire portfolio can suffer. This is where diversification comes in. Diversification means spreading your money across different investments instead of depending on only one company or one stock. The main idea is simple. Don't put all your money into one investment. By spreading your money across multiple investments, you can reduce risk and build a more balanced portfolio. Let's look at a simple example. Suppose you invest only in one Apple stock. If Apple performs well, you benefit. But if Apple has a bad year, your investment could fall sharply because everything depends on one company. Now compare that with owning many companies such as Apple, Microsoft, Amazon, Nvidia, Google, and hundreds more through an ETF or index fund. In this case, your investment does not depend on just one company. If one company performs badly, others may still perform well and help balance the portfolio. Buying one stock can be risky because every company faces its own problems. This is called company specific risk. A company can have poor earnings, bad management decisions, product failures, lawsuits, regulation issues, or an industry slowdown. Even strong companies can go through difficult periods. That's why depending on only one company can be dangerous. If that company runs into trouble, your entire investment may be affected. Diversification helps by spreading risk across many investments. When you own multiple companies, one company falling may not hurt your portfolio as much. For example, one stock may go down, but other stocks in your portfolio may stay stable or even go up. This can help balance losses and make your portfolio less dependent on one investment. Diversification does not eliminate risk completely, but it reduces the impact of one bad investment. Diversification can happen in different ways. First, you can diversify across companies by owning different stocks instead of just one. Second, you can diversify across industries such as technology, healthcare, finance, energy, and consumer goods. This matters because different industries perform differently at different times. Third, you can diversify across countries by investing in both US and international companies. And finally, you can diversify across asset types such as stocks, bonds, cash, or real estate. The goal is to avoid depending on only one area of the market. To summarize, diversification means spreading your investments across different companies, industries, countries, and asset types. It helps reduce dependence on one stock or one investment. ETFs and index funds make diversification easier because they allow investors to own many companies through a single investment. Diversification does not guarantee profit though, and it does not remove all risk, but it can make investing safer and than betting everything on one stock. So the key takeaway is this: diversification is about reducing risk and building a more balanced portfolio.